Hello everyone, thank you for joining our live session. I'm Marilena and I will be your hostess for today. We will start with Week Ahead by our Senior Research Analyst Peter Iosif. Later on, we'll be going over more account types with Odysseas and Savas, which will be followed by Emily Gozzoni, who will guide you through some crucial trading tips. For our closing, we'll have some key points of the day by Christina Pieridis.
Leaving behind us a turbulent week, we take a sneak peek into what next week has in store for the markets. On the monetary front, we note the releases of the interest rate decisions of the CMB from the Czech Republic on Wednesday, as well as Norges Banks from Norway and CBT from Turkey on Thursday. Also, please note that RBA is to release the minutes of its June meeting on Tuesday. Furthermore, various policymakers from central banks around the world are scheduled to make statements and could sway the market's opinion. As for financial releases, after a quiet Monday, we note on Tuesday UK CPI trends for industrial orders for June, Canada's retail sales for April, and on Wednesday we get New Zealand's trade data, UK's and Canada's CPI rates, all releases being for May, as well as the preliminary consumer confidence of the Eurozone for June. On Thursday, we note the release of Australia's, Japan's, France's, Germany's, the Eurozone's, UK's and the US preliminary PMI figures for June, UK CBI distributive trades for June, and the US weekly initial jobless claims figure. On Friday, we get from Japan the CPI rates and UK's retail sales both for May, Germany's IFO indicators, and from the US the final University of Michigan consumer sentiment both for June. The USD index seems about to end another week in the greens, despite some correction lower stemming from the Fed's interest rate decision. It was characteristic that despite the Fed delivering a 75 basis points rate hike, as was expected, the first since 1994, the greenback after Jerome Powell's press conference moved lower. In its accompanying statement, the bank stated that the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge and that could impede the attainment of the committee's goals. In his press conference, Fed Chairman Jerome Powell was reported stating that from the perspective of today, either a 50 basis points or a 75 basis points increase seems most likely at our next meeting, which did provide some ambiguity for the bank's intentions. The market may have expected more decisiveness from the bank and may have been partially let down. Yet the monetary policy tightening of the Fed continues at a rather fast pace, thus could provide some support for the US dollar. Please note, though, that Fed Chairman Powell is scheduled to make statements during today's American session and could provide a clearer view in regards to the Fed's monetary policy outlook. Overall, in the coming week, given the low number of high-impact US financial releases, we may see the fundamentals taking over in guiding the greenback. Nevertheless, we would like to note on Tuesday the release of the existing home sales for May, on Thursday the release of the weekly initial jobless claims figure and the release of the preliminary PMI figures for June, and on Friday the final University of Michigan consumer sentiment for the same month. The pound's weakening against the US dollar seems to continue for a second week in a row, and the pound is losing ground also against the euro and the yen in a sign of a broader weakness. It should be noted that the pound retreated on a weekly basis despite BOE delivering a rate hike of 25 basis points as expected. In its accompanying statement, the bank mentioned that the MPC will take the actions necessary to return inflation to the 2% target sustainably in the medium term, in line with its remit, which tended to imply that more rate hikes are to come. Yet it should be noted that the bank seems to be sticking to its gradual approach for now, at the pace of 25 basis points rate hikes per meeting in raising its interest rate. It should be noted, though, that the balance of power within the bank seems to be shifting towards a more hawkish stance, given that 3 out of 9 members of the Monetary Policy Committee voted in favor of a 50 basis points rate hike. We see the case for inflationary pressures being the determining factor behind BOE's future rate hiking policy, and thus tend to highlight the release of UK CPI rates for May on Wednesday. Should the rates accelerate beyond April's 9% year-on-year, we may see the pound getting some support, as such rates would be increasing the pressure on BOE to hike rates at a faster pace. We would also note the release of the preliminary PMI figures for June, especially for the services sector on Thursday, and a drop of the related readings could imply further slowdown of economic activity in an already shrinking UK economy, as indicated by the GDP rates for March and April. We would also like to note the release of the CBI indicators for June on Tuesday and Thursday, while on Friday we get the UK's retail sales for May as well as the GfK consumer sentiment for June. On a more fundamental level, tensions of the UK with the EU over the Northern Ireland Protocol seem to be about to escalate, and such a scenario could weaken the pound, as the last thing the UK economy currently needs would be another trade war with the EU. JPY seems to have been able to break the losing streak of the past 2 weeks against the US dollar, but is also strengthening against the euro and the GBP in a sign of a broader strength, and that with BOJ's interest rate decision being out. On a more fundamental level, we note that Japan's Prime Minister Kishida is to attend the Nato Summit near the end of June, which would be Japan's first time. The move could instigate substantial frictions in the relationships of Japan with China and Russia, not mentioning North Korea, but also strengthen the relationships of the country with the Western Alliance. As for financial releases, we would note practically two from the land of the rising sun. The first would be on Thursday, when we get the Jibun Bank preliminary manufacturing PMI figure for June. A possible rise of the indicator's reading would be signaling a faster expansion of economic activity for the crucial Japanese manufacturing sector. The second would be on Friday and may be the crown of financial releases for Japan next week, as we get Japan's CPI rates for May. Should the rates accelerate, we may see JPY getting some support, as that would increase the pressure on BOJ to act. It should be noted that we see risks related to the release as tilted to the upside, given the weakening of JPY in the past month. Also note that JPY status as a safe haven could be on display once again next week. The common currency seems to be losing ground for a second week in a row against the US dollar. It seems also to be losing ground against the JPY and tends to gain against the pound. On a monetary policy level, after ECB's interest rate decision, which we analyzed in last week's report, we note that the bank seems to have reached new decisions, as the possibility of yield fragmentation was visible on the horizon. We note that the spread between the yields of Italian Greek on the one side and German bonds on the other widened, ringing the alarm bells in the bank's headquarters in Frankfurt. In an extraordinary meeting, the bank on Wednesday decided to flexibly reinvest redemptions coming from the PEP portfolio to preserve the functioning of the monetary policy transmission mechanism. In addition, the bank decided to accelerate the completion of the design of a new anti-fragmentation instrument. The decision seems to show that the bank is actively moving to stop fragmentation, which could be a positive for the common currency, yet Euro traders may need more concrete evidence for the bank's decisiveness and ability to produce such an instrument. Also, please note that ECB President Lagarde is about to make statements over the weekend and could provide a clearer view in regards to ECB's intentions. As for financial releases, we note on Wednesday the release of Eurozone's preliminary consumer confidence, while on Friday we get Germany's IFO indicators, both being for June. The crown of financial releases for Euro traders next week, though, should be the release of the preliminary PMI figures for June. It should be noted for the record that all the main indicators of France and the Eurozone dropped in May, with the exception of Germany's manufacturing sector saving the day by rising a bit. Should the readings drop further, implying a wider slowdown of expansion of economic activity, we may see the common currency weakening. AUD is about to end the week in the reds for a second time against the US dollar. It should be noted that the Aussie failed to gain traction in the past few days despite China's robust industrial data for May. It should be noted that China's industrial output growth rate for May outperformed market expectations, escaping negative levels and showing growth once again. The release could imply a greater volume of orders for Australian exporters of raw materials, yet that did not seem to excite Aussie traders. Also, the release of Australia's employment data for May failed to excite traders. Despite the unemployment rate remaining stable at 3.9%, the employment change figure jumped to 60k, implying a tightening of the Australian employment market. Such a tightening of the Australian employment market could boost the confidence of RBA, which had linked in its last interest rate decision future interest rate hikes to the data regarding employment and inflation. Please also note that in the coming week, RBA is to release the minutes of its June meeting during Tuesday's Asian session, and the release could generate substantial interest among Aussie traders. Also on the monetary front, we note that RBA Governor Lowe is to make statements on Monday's Asian session, and if he sounds hawkish enough, may generate some support for the AUD. As for financial releases, we note Australia's preliminary PMI figures for June on Thursday. Hence, we would expect fundamentals to be in the driver's seat for Aussie traders next week, and a possible improved market sentiment could provide some support for the commodity currency, which is considered a riskier asset, and vice versa. The loonie seems to be weakening against the US dollar as the week draws to a close. The weakening of the CAD could also be partially, at least, attributed to the drop of oil prices, as well as the wide drop of natural gas prices for the US. As for oil, it seems that the surprise rise of US oil inventories, as reported by AP and the EIA in the past few days, tended to weigh, as they would imply a slack in the US oil market. Oil prices, on the other hand, could recover on a tight supply side and a firmer demand outlook. Overall, such fundamentals could imply that the lowering of oil prices would be considered as corrections lower, which could be short-lived and or shallow. In addition, on Wednesday, US natural gas prices managed to regain some of the ground lost on Tuesday, but were nowhere near to rebounding. US natural gas futures plunged around 17% to a 5-week low on Tuesday on expectations of an extended outage at the Freeport liquefied natural gas export plant in Texas, which would leave more gas to refill low US stockpiles and thus could weigh on the CAD as well. On the other hand, on a more fundamental level, we note that the commodity currency may prove sensitive to the direction of the market sentiment, given that it's considered a riskier asset. Should the market sentiment be cautious in the coming week, we may see the CAD losing some ground. As for financial releases in the coming week, we note the release of Canada's retail sales growth rate for April on Tuesday, yet the highlight is expected to be the release of Canada's CPI rates for May on Wednesday. Should the rates accelerate further, we may see the determination of BOC to curb inflationary pressures through faster and wider rate hikes being hardened, thus providing some support for the CAD. It's characteristic that economists have issued warnings that BOC may start mirroring the Fed's 75 basis points rate hikes in an effort to lower inflationary pressures. As a closure, I would like to make a small comment for the interest rate decisions expected in the coming week. We make a start with the Czech Republic's CMB. The bank has been hiking rates, and characteristically in the May meeting proceeded with a 75 basis points rate hike. Yet the CPI rate accelerated further in May, reaching 16% year-on-year, a level not seen for over 25 years, handling probably a shock to CNB policymakers. We would expect the bank to hike rates once again, probably with another 75 basis points rate hike, if not even wider, and at the same time remain substantially hawkish, foreshadowing more rate hikes to come. From Norway on Thursday, we get Norges Bank's interest rate decision, and we would expect the bank to stick to the script and hike rates in the coming meeting as it remained on hold in the last one, and CPI rates accelerated further. It's interesting to see whether the bank's forward guidance will be tweaked more to the hawkish side, a scenario which could provide some support for the NOK. Last but not least, on a more exotic note, we would like to see how the Central Bank of Turkey will behave also on Thursday. The bank has maintained its 1-week repo rate at 14%, with inflation for May accelerating further and reaching 73.5% year-on-year, while Turkey's President Erdogan warned that his government will try to lower interest rates even further. Should the bank actually maintain rates unchanged once again, we may see the lira starting to weaken. Should the bank show intentions of cutting rates further, we may see the lira weakening substantially, practically sending the Turkish economy in a negative spiral.
guys.
Last time we spoke about the live floating spread accounts. Today I have Odysseus again, so we can talk about ECN and Sstp accounts. Odysseus.
Hi guys. Nice to be here with you again. So today, as Saba said, we're going to be talking about the Sstp accounts and the ECN accounts. Do you want me to break it down for you a little bit?
Yeah, just explain how everything.
Okay. So to start with, what is an Sstp account? Sstp account is basically a straight through processing account, which is a forex brokerage model that involves sending clients client orders directly to the market without passing them through a dealing desk.
All right.
Right. So this is the Sstp accounts, straight through processing.
And what's the other one?
It's the ECN, which is basically electronic communication network. What does that mean? Basically, it's an account which is a choice of professional traders who basically want the best possible trading conditions, right? So the ECN account allows buyers and sellers to trade directly without any middlemen.
All right.
To open an ECN account, you need to make an initial deposit of 1,000.
Okay.
So that's the ECN account, which is the electronic communication networks.
All right. Can you break them down, like, instruments and lot size?
Yeah. Let me show you here on the screen as well. Let me extend it for you guys. So we got the no commission account type, as you guys can see here, which you can trade forex, metals, indices, and commodities with a minimum lot size of 0.01.
Okay.
And the basic currency is USD, Euro, Bitcoin, and JPW. Sorry about that. And the spread is 1.7. And I mean, this is the only account that you can see it has a spread on.
Mm-hmm.
But below you see there is no commission. Right.
All right.
You can have a flexible leverage up to 200, and the stop out is on 50%. Obviously, we have the Islamic accounts, which is free account, and the account manager, and of course the dealing department for transactions, right? And we have the zero spread account. It's the forex, metals, indices, and commodities that we have available again, and it's on a lot size of a 0.01. Now here, the only difference is that you cannot trade with you cannot have a basic currency of Bitcoin. Yeah. But you have US dollar, you have euro, and you have the Japanese yen.
And the spread is zero.
Yeah, the spread is completely, it's not existed. But there is a commission. I mean, there's a basic standard commission, yeah. And
Makes sense.
And the flexible leverage, which is we can go up to 200. Again, the stop out is on 50%. We have the Islamic, of course, a dedicated account manager, and the dealing department. Now, about the third account, which is called Absolute Zero, it has, as before, forex, metals, indices, and commodities, 0.01 minimum lot size. And as the zero spread account, you got US dollar, euro, and Japanese yen. Yeah, no Bitcoin. Again, you have a zero spread on the account, and you have no commission, right? Okay. Now, yeah, that's nice. Yeah, and of course, leverage up to 200, stop out on 50%.
So free again.
Yep.
So on all, basically. Yeah. All right.
Yeah,
that's very good.
Basically, these are the three account types that we have for straight through processing and for electronic communication network.
All right, that's fantastic, Odysseus. Thank you very much.
Thank you. Thank you.
And we'll meet again for the next one.
Yes, that's definite. For next week, I suppose. It's a Friday today, so I wish everyone a great Friday and a great weekend. And see you guys next week.
See you guys. Thank you very much.
Thank you.
Bye-bye.
Hello everyone, my name is Emily and welcome to today's trading tips. Let's get started. Thinking in probabilities. Facing reality is very important, so let's just say you have an average of 150 trades per month. Some of them will be winners and some of them will be losers. Don't try to beat that. There are people trying to have an accuracy of 100% hit, and that's just not going to happen. That's like saying you can predict the flip of a coin 100 times in a row. No chance. Also, the financial market moves with probabilities. In certain cases, the probabilities of the market moving in certain direction are higher. That's the moment you're looking to identify with and take advantage of. Thank you very much. Hello everyone. Psychology is key. Every trader is a psychologist at heart. When you're planning your next move, you must analyze market movements as well as master your own psychology. Never forget that fear on the one hand and the wish to advance yourself on the other are fighting within you. When you are setting your plan, it's not enough to analyze the market movements and the fundamentals behind it. You have to analyze yourself as well. If you are rushing into a trade, ask yourself, do I really feel comfortable with this trade? Or on the flip side, why am I not entering this trade? Such questions make your trading conscious. Master both greed and fear. Make them work for you, protect you from losses, and at the same time, let them enhance your own unique trading style. Thank you.
After the FOMC triple rate hike on Wednesday, the Swiss National Bank and the Bank of England followed a similar strategy and increased their interest rates accordingly. The biggest surprise for the markets was the SNB that carried out a double rate hike, sending shock waves across the market and structuring an organized buying trend for the CHF. USD CHF came under fire as traders rushed to short the currency pair, leading it to its biggest daily sell-off in years. The unexpected double rate hike tends to highlight the CNB's urgency to fight inflationary pressures. On Thursday, USD CHF was the biggest daily mover among major forex pairs by far as a result. The CHF also gained ground against the euro and the GBP during the session. Bank of England's rate hike of 25 basis points initially enacted a weakening of the GBP against the USD, but cable rebounded in the next hours, ending the day positive. Euro GBP, a currency pair that reached a new yearly high in the past days, relented ground and returned lower, ending the session in red area. On Tuesday, the session was also characterized by the weakening of the USD. The dollar index was down while the USD lost ground against most of its major counterparts, including the euro, GBP and JPY. The USD's weakening may have been motivated by negative US economy releases, like the housing starts and Philly Fed Business Index, which displayed rather disappointing results. However, on Friday, USD traders expect the US industrial production rate for May, but also a speech by Federal Reserve Chair Jerome Powell, as both events can potentially create volatility. Moreover, US stock markets continue their descendants on Thursday, with the major index dropping and testing new 2022 low levels. Major tech companies like Amazon, Apple and Microsoft sold off during the session. Another significant economy release on Friday is the final Eurozone headline and core HICP rates for May. On Thursday, the euro gained ground against the USD but lost against the CHF. USD CHF dropped in a consecutive hourly session on Thursday and tested the 0.9660 support, but seems to have rebounded some ground in the latest sessions. If the rebound is to persist, we could see traders aiming for the 0.9795 resistance. Yet, with the RSI indicator remaining nearby 30, we could say the currency pair remains in a selling trend. In the scenario of an extensive selling trend, we may see a bridge below the 0.9660 support, which could lead the price action to lower grounds and possibly the 0.9575 hurdle. USD JPY was on the rise in the early morning on Friday, surging and testing the 134.60 resistance briefly. Even though the strong bullish trend was interrupted and some correction was carried out, the price action remains nearby the R1 for now. If the R1 is breached, we could be in for a ride to higher levels like the 135.05 resistance or even the 135.55 barrier. Please note the R3 is the year high level for the currency cross, making an important challenge for traders. In the opposite direction, a move lower could send USD JPY testing the 133.30 barrier. Yet for now, the pair displays strong bullish interest. On Thursday, the energy commodity that benefited the most was WTI, which advanced in the US session and reversed the losing strike it was in since the previous days. For the most part, analysts are citing a lack of supply as the main driver for higher oil prices, which has been inviting bullish tendencies for WTI in the past months. On a separate note, the US announced new sanctions on Iran, making it even more difficult for Persian oil to be included in global oil output and trade. Furthermore, Libya's oil output has diminished substantially compared to the previous year's supply levels. On a contradicted note, natural gas prices initially advanced but then declined on Thursday, closing the session in red territory. According to various sources, Russia gas supply to Europe via the Nord Stream 1 pipeline is reduced. Some analysts tend to note the reduction of Russian gas is a strategic move to lift the commodities prices even higher and place more pressure on Europe for its sanctions towards Russia. WTI is currently trading just below the 115.50 resistance level, probably making the first target in a buying scenario. If this level is captured, we may see traders turning their attention towards the 120.95 barrier, which was tested previously in June but was not surpassed. In our view, WTI remains in a sideways trend line but made to be prone to bullish tendencies. If the commodity comes under selling interest, we may see a move towards the 108.8 support. The Central Bank of Japan kept its interest rate steady at minus 0.10% as expected, but volatility was evident for the JPY. USD JPY gained during Friday's early European morning, while the JPY also lost ground against the Euro and the GBP.
Our live session has come to an end. Thanks for watching. Tune in again on Monday. Enjoy the rest of your day and have a great weekend.